you expect this spurt higher in yields to have some more room to go? What's kind of the point where you take a step back and think that it's time for a breather?
Yeah, good morning, Heidi. Yeah, we do think that there's room for Treasuries to head towards that 2 to 2.25% level, which is kind of consensus there. If you think about what drove the rise in bond yields this time last year, it was more about a repricing of the short end of the yield curve as the market made way for the Fed to initially taper and then start tightening policy. The next potential leg in this move higher in bond yields might be the return of term premium. So it could be that the market is already fully pricing 150 basis points of hikes by the Fed. We wouldn't argue with that particular pricing. Where we do potentially disagree where the current market levels are, is it a return of term premium to the longer end? So 10-year bond yields and longer dated bond yields could drift higher from these levels based on a return of term premium, maybe due to some quantitative tightening that could occur into 2023.
Traders' pricing when it comes to Fed expectations is getting so aggressive. On the other hand, you've got PBOC expectations towards potentially a more mix of more easing measures this year. How do you play that divergence?
Yeah, that's been actually a very good position to hold amongst global accounts, is to be basically underweight US rates and overweight China rates. That worked well in 2021 and kind of see no reason for that to not continue working into the early stages of 2022. The yield differential between, let's say, 5-year China bonds and US 5-year bonds is around 100 basis points. That's still, I think, an attractive entry level, particularly given, we were talking about the Fed potentially becoming more aggressive and starting to talk about 50 basis points of tightening at some stage this year. The PBOC surprised the market yesterday with not just its easing of policy. I think that was expected, but the size of that easing and the injection of liquidity, I think, is a fairly clear signal that China rates are going to be well supported. It's never a one-way bet that maybe we have some correction in the short term, but I do see the pressure for China rates to head lower relative to global rates as still a position worth taking in bond funds.
Brad, just looking at the other side of the sort of equation here, how much of this backing up in global bond yields is also due to supply and a lot of just whether you're a government or a lot of these corporates trying to lock in those financing costs before things, to your point, move up further?
Yeah, I think that's probably the next penny to drop, or the shoe to drop. So again, that initial rise that we've seen in Treasuries is more about pricing for the Fed, but then as a large buyer of government bonds steps away, i.e. the Fed, and starts to reduce its purchases first, then stop its purchases, and then potentially start actually selling into the market or not reinvesting, that supply pressure, whether it's from the Fed or, as you say, corporate issuers, is likely to be the main driver of this next move higher in bond yields. In terms of other things that could generate a higher move in bond yields, clearly inflation. But again, I think the market is fairly on board already when we look at what has priced into inflation expectations in terms of break-evens in the high 2s and 3% in the US. That seems fair to us. The Fed's still only expecting 2.6% inflation in 2022, so I think they could be somewhat surprised. But I think the next move in higher in bond yields is mainly due to that, as you say, that supply pressure that could be coming.
Now, Brad, a concept you brought up earlier, I wanted to sort of flesh that idea out a little bit more because this might also affect cross assets. Term premium, the 10-year term premium that's currently negative, do you see that moving into positive territory? And alongside that, 10-year real yields, do you also see yields rising to the extent that we also get a positive print on that one?
It's a long way to go for US real yields to go positive, so maybe I'd push back against that. And I'd also, I guess, push back against can bond yields return to sort of pre-COVID, pre-GFC levels? And I suspect the level of debt globally, that's unsustainable. So yes, we can see real yields rise from here. If you look at the 5-year US real yield, it's already risen about 50 basis points. And what's surprising there is that actually hasn't really coincided with a stronger move in the US dollar, which is kind of an anomaly. So yeah, we see room for real yields to move higher, but to get back to positive in markets like the US or the UK or Europe, I think is a bit of a stretch. Unlike in China, where inflation in China is expected to be around 2%. In 2022, their yields are around 2.5% to 3%. So you are getting a positive real yield in certain large bond markets, and that probably has implications for the renminbi as well.